Hi everyone, welcome to another video. Today we are going to discuss about accounting concepts and conventions. So the objectives of today's lessons are the purpose of accounting concepts and conventions, the meaning and difference of different accounting concepts, and evaluate the use of international accounting standard. So let's discuss in detail what are the different accounting concepts. There are fundamental concepts. We can categorize four concepts under fundamental concepts. The first accounting concept it is going concern. Going concern means every business or the accountant who prepare the financial statement will have an assumption that the business will be continuing for a foreseeable future. That means the business will continue its operation for an infinite period of time. So, if you have that intention, you bought a new machinery or any non current asset, instead of recording that one as an expense, we can spread over the cost of non current asset over its working life. That means depreciation actually we are charging on the basis of going concern concept. So going concern concept means the business will continue for a foreseeable future. The application it is the depreciation calculation. Moving to next accounting concept, consistency. Consistency means in accounting we have different policies and methods for calculating different transaction or adjustments. So if you following any accounting concept, in the sense if you are following any accounting treatment or method or policy, it should be continued. For example, depreciation you can calculate by using three methods: straight line method, reducing balance method, and revaluation method. So first, if you decided to charge depreciation under straight line method, you should continue that method at least during the life period of that assets. In real life, you can change the method of depreciation, but there are necessary adjustment you have to take care. Anyway, accounting concept consistency does not allow you to change any method of depreciation or any other policies. So in exam you can see like a company decided to change its method of depreciation, which accounting concept they violated. So without any doubt you can comment or you can answer it is consistency concept. Next concept it is prudence concept. Prudence concept means the business should anticipate or assume all possible losses but not profit. So if an business expecting any loss, like some customers may not be going to pay, it is provision for, we have to keep a provision for doubtful debt. It is actually on our assumption some customers won't pay. So we have to charge or we have to record all possible losses. It is to not to overstate our asset, in the sense if you are not considering the chance of customers not paying, your trade receivable will be overstated. It is not allowed. So prudence concept means you have to anticipate all the possible losses, not the profit. For example, in your real life, you are planning to go for a vacation, some international tourist destination you are planning to go, suppose London. You have an approximate traveling cost with accommodation around $2,000 for 15 days. So that is your assumption, right? So when before you starting your travel, you got to know that your friend is there, so he will be providing you accommodation and food. That is your assumption. So you assume that I can save $500, my expense will be only 1,500. In that scenario, you assumed a gain from your friend. Actually, it is not allowed in accounting. You are not supposed to anticipate any profit. In another way or in another situation, the same situation, you are going for a vacation to Paris or London. That time actually you expected 2000, but you got to know your friend is there, so you are assuming I have to take care of him, I may go to shopping with him, so an extra 500 I may have to spend. So you have to expect that expense also. That means 2500 you will be recording as an expense. It is allowed in accounting. So prudence concept means we have to consider all possible losses and expenses, not profit. Next one, accrual or matching. Accrual or matching concept means the income and the expense should be matched. That means if you are getting an income or if you are getting a benefit, it should be matched with the amount you paid. For example, if you are in a rented building, you stayed there for 12 months. If you stayed there for 12 months and you paid only 10 months rent, when you check the cash book or bank account, you can see 10 months we paid. But in income statement, not only the 10 months rent, you have to add the 2 months rent you didn't pay, outstanding rent. Then only our income statement will follow accrual or matching concept. You stayed there for 12 months, you paid only 10 months. So if you record 10 months rent as an expense, it won't match with the gain or benefit you enjoyed. So accrued we have to add. So accrued we will add, prepaid we will minus. It is based on accrual or matching concepts. Then in addition to those four fundamental concepts, you have to be clear about some other concept also. It includes historic cost. Historic cost means asset should be recorded at cost price, not at the market price. If you bought a machinery for 100,000 2 years before, presently the market value is say 10,000. You are not supposed to record 10,000. You have to record the cost minus depreciation. The market value we don't consider. That is actually historic cost concept. Money measurement. In accounting, we can record only transactions which can measure in terms of money. The qualitative characteristics or any like skill of an employee or honesty, these all are very important for the business. Goodwill also. So these items actually we can't measure in the form of money. It is qualitative characteristics. So these things we can't record in accounting. So money measurement concept says that we have in accounting you can record only transaction which can measure in terms of money. Then business entity, or it is also known as separate entity concept. It assumes that the business and its owner are separate. They are not. Even it is his business, we have to, in business point of view or in accountant point of view, you have to consider both of them separately. That means if he took any amount from business, we should deduct as a drawings. And if he paid any amount for his personal expense, we don't record it as an expenses of the business. Suppose he paid the rent of his home or he paid the insurance of his vehicle. We don't record that one as a expenses of the business. In income statement you can't see. But from capital, in financial position, we have to deduct. From capital less drawings, that time we will record. So business entity concept means business and its owner are separate. Then materiality principle, it says that if it is a small valued item, you have to negligible amount, you have to record, you don't need to record it separately. You can combine and record it. And another example is, suppose you buy a stapler or some stationery items, that one we can use for many years. We can consider it as a non-current asset if you wish. But it's a small valued item. We can consider it as an expenses of the business. So materiality concept vary from business to business depends upon the size of that business. So materiality, small valued item, we have to record it as an expense rather non-current assets. Realization concept means when we have to realize or when we have to record an item as a sales of the business. Suppose a random customer visited your shop and he was inquiring about how much for this product, or he telling, okay, I wish to buy this product, or he given an order, I will buy this product or after 2 days. By getting an order, we can consider it as a sales unless we pass or we give the title of the goods to the customer. That time only we can realize or we can record it as a sales. That is realization concept. Then duality, accounting is based upon duality concept. Every transaction there will be a debit and credit. That is actually duality concept. Then substance over form. This is actually applicable for AS level students. Substance over form means the principle ensure that financial statements are prepared using substance of transaction rather than their legal form. For example, if you purchased a motor vehicle on hire purchase terms, so he will be paying an initial amount and he will be paying EMI every month. So when you check the document of that vehicle, you can see it is hypothecated to a bank. So he's not a real owner. It is actually bank funded for that vehicle. But he will become the owner after maybe 5 year or 6 year. Until even he will be the owner after 5 year, we will be recording it as an asset because legally we are not the owner, but logically or substance we are using that we are the owner. So this is applied by substance over form principle. Let's practice or let's try with a question. Here, explain accounting concept or convention Samantha applies for her financial statement for each year of the following. First one, she charges money taken for personal use to her drawings account, not to general expense account. Which accounting concept she followed? Think for 1 second, 2 seconds. Yes, it is business entity concept. The owner and the business are two separate entities. Next one. She used only one method to depreciate non-current asset. Yes, consistency concept. Any method or policy followed by a business should be continued. Third one. Non-current assets are recorded in the books at their purchase price until they are sold. It is historic cost concept. Next. Fourth one, debt are considered irrecoverable when Samantha is informed that debtor may be bankrupt. It is actually on the basis of our assumption. We are assuming he may become bankrupt. So which accounting concept allow you to anticipate all possible losses? It's none other than prudence concept. Next one, the financial statement do not contain any valuation for her skill and experience. Yes, it is money measurement. In accounting, we can record the transaction which can measure in terms of money. And finally, the last one, sixth one, she does not assume the profit is made until the goods are sold to a customer. Yes, realization concept. She followed the realization concept. So these are the answers for this. Then, so we discussed the main accounting concept. I hope all the concept you got a little idea. For further information, you can read your textbook. I hope you enjoyed the video. Thank you for watching.